Howdy everybody, welcome back to Accounting 1101. Professor Martin here, as always, your tour guide as we journey through the world of accounting. We are talking about adjusting entries today, and the category of deferrals. We have accrual adjusting entries and we have deferral adjusting entries. We've already talked about the accrual part, and now we're going to talk about the deferral part. You may remember from last time in our previous video, we talked about a few characteristics of adjusting entries. First of all, they're always made at the end of the period before we make our financial statements. We do all the transactions that occurred during the period, and then at the end, we make adjusting entries to clean up our accounting records. And then the other big point that we've made with adjusting entries, we've talked about how every adjusting entry that we make has one balance sheet account in it and one income statement account. Every adjusting entry, one balance sheet account, one income statement account. So we've gone through the accrual entries. We've talked about how revenues and expenses have happened, but they have not been recorded. And my goodness, I still have not updated that typo yet. If you are really good at proofreading, taking applications, you can be my proofreader. The job doesn't pay anything, but you'll have my eternal gratitude. We are accruing revenue and expenses in those particular entries. They haven't been added in, so guess what? We've got to add them in. That's what accrual means in accounting. It means to add in. We've had a revenue or an expense that has happened. We haven't recorded it. We got to add it in via an adjusting entry. We've been through all that. I showed you examples. We've worked examples in the homework. Now we are at the point where we are looking at deferral adjusting entries, where cash has traded hands, but we haven't had a revenue or expense happen yet. Cash has traded hands, but the revenue or expense has not happened. We are deferring that revenue or expense. And of course, defer means wait until later, just like in football when they do the coin flip, right? At the beginning of the game, and one team wins that coin flip and they say, we're going to defer. We'll get the ball later on. They can have the ball to begin with. Defer simply means wait until later. We're waiting until later to record that revenue or expense. And so, well, why in the world are we waiting until later? Because it hasn't happened yet. Remember, in our accounting system, we record revenue and expenses when they occur. It's going to occur later on. We'll record it later on. All right, so we'll give you some examples here. A deferred revenue. A company has collected money, has collected cash, but they haven't earned it yet. They've taken the customer's money, they've taken the client's money, but they haven't provided any good or service yet. They'll provide it later on. And believe it or not, we see it all the time in our modern economy. This idea of taking a customer's money, but not really providing them with anything yet. So kind of ponder that for a moment. Maybe pause the video and think. Can you think of any scenarios where a business takes a customer's money, but they haven't given them anything yet? I'll give you some examples. You ever bought a gift card before? You go into Starbucks, you buy a gift card, you give Starbucks $25, and they give you a card that says, hey, come back later and we'll make you a coffee. Right? That's an example of a deferred revenue. You've given a company money, but they haven't really given you anything yet. And then you come back a month later, you plop your card down and they make your coffee and they take that value off of the card. That's an example of deferred revenue. You're giving Starbucks money, but they haven't earned it yet. So any kind of gift card is an example of deferred revenue. Company takes your money, they haven't provided you with anything yet. Or maybe if you're a gamer, you've bought a year-long subscription to an online platform like PlayStation Plus. You pay for a year up front. They haven't really given you anything yet. And they're going to earn that money month by month as you use up your subscription. Magazine subscription, the exact same idea. You buy a year of Sports Illustrated or whatever magazine you think of, and you pay that up front, and then they send you the issues. They're earning that money as they go along. Deferred revenue. Or maybe you've bought season tickets before. You buy season tickets to the Reds. You buy them in December or January when the weather is awful, and you pay that money. You think about all the good times you'll have during the summer when they play the games and you can go watch them. It's an example of deferred revenue. You pay $1,000 for your season tickets in December, and then the Reds earn that money as they play the games in April, May, June, July, August, and September. Notice I didn't mention October because the Reds never make the playoffs, so we never have to worry about baseball in October in Cincinnati. Or maybe, one more example, you buy a gold pass for Kings Island down in Mason, and you pay for that in maybe November, December, January. You pay the money for your season pass, and you can use it all year long when the park is open. You pay the money up front. The business hasn't earned it yet. They've got to open the park and earn that money. So, deferred revenue. I'll also call it unearned revenue. Deferred revenue or unearned revenue is when the company takes your money, but they haven't earned it yet, haven't provided anything yet. So, give you an example. At the end of December, Net Solutions, our sample company, had a $360 balance in unearned rent. Again, unearned rent, unearned revenue, whatever we call it, is a liability. They've taken money. Now they're liable to that customer or that tenant or that client. At the end of December, they have earned 1 month of that rent. Remember, we're talking about renting a piece of land. The tenant paid for 3 months up front, gave our business Net Solutions $360, and now we're earning that $120 a month at a time. So, we need to decrease our unearned rent by $120. We've earned 1 month. We need to take away 1 month of liability. We're not liable for that 1 month anymore. And remember, under accrual accounting, we record revenue in the period we earn it. Even though we took the cash at the beginning of the month, we can't immediately recognize that as revenue until we have earned it. So, we go back to our unadjusted trial balance, and we see right there we've got unearned rent, a liability, credit balance, $360. That represents, again, 3 entire months of rent where the client has prepaid up front, paid up front. 360 is the total. Divided by 3 means 120 a month is what we are earning. So, let's do an adjusting entry here. We've got to take away $120 of the liability and recognize that revenue. Deferral. We're deferring revenue until we earn it. Here we go. We're going to debit unearned rent. That liability account needs to go down. Liabilities go down on the debit side. So we're taking away 1 month of that liability and we're counting it as revenue. We have earned $120. We can count it as revenue. From an account standpoint, you can see we go from $360 of a liability in unearned rent to $240. We've earned 1 month. Now we only are liable for 2 months, $240. We count the 1 month as revenue in December, just like that. So that's our example of deferred revenue. Again, you may see it called unearned rent. You may see it called unearned revenue. Whatever the case might be, we've taken money from a customer. We haven't provided them with anything yet. So we have a liability to them. We either have to provide the good or service, or we have to give them their money back. In fact, there's a great example of that. There's an accounting story there. And I'll throw it out there. Y'all mentioned, or I mentioned, I should say, Kings Island earlier in the video. You may be familiar with the water park just down the road from Kings Island, the beach. 1 year, they took customers' money all winter long for season passes to the water park there. And then in about February, they said, hey, you know what? We don't have enough money. We're not going to open. Like literally, they just said, we're not going to open. So what happens to all of those people who gave them money? Well, technically, the beach should have refunded that money since they weren't going to open and provide them with the water park access. I think they were in such dire financial straits that they weren't able to do that. And Kings Island kind of stepped in and said, hey, we'll honor those passes at our water park if you bring them here. That way you won't be put out. And so a little savvy business move on the part of Kings Island, swooping in and saving the day there. But normally when a business takes money up front for something, they either have to provide that something or they have to refund the money. Deferred expenses are other category of deferrals here. Again, Cash is traded hands, but the expense hasn't happened yet. And so it's kind of like a prepaid expense. And then again, in accrual accounting, we want to record expenses in the period they happen in, not necessarily in the period where we pay the cash. So, give you an example, we've seen already, supplies. We got our supply closet, we bought a bunch of supplies, stuck them in the closet, we have an asset of supplies. And we're pulling from that supply closet, we're using up the supplies as the month goes along. Net Solutions had an unadjusted balance of $2,000 in their supplies account, meaning they had bought $2,000 worth of supplies. But after counting, they found they only had $760 worth on hand. So they've used up $1,240 of supplies during the month of December. Need to make an adjusting entry for that. We record expenses in the period they happen. And so we need to record the fact that we've used up supplies and we have an expense. We've used them up. There's our $2,000 on the unadjusted trial balance and supplies. Again, we need to make an entry that shows we've taken supplies out of supplies and used them up. We're moving the amount we used out of the asset balance to the expense account. So an entry to do that, just like we see right here, supplies expense debit and a supplies credit to the supplies asset account. We can see our supplies account goes down $1,240 to reflect our balance that we really have in the closet right now. And we can see we've added the amount we've used up to the supplies expense account. Another example that we see a lot are prepaids. We prepaid an expense, prepaid insurance, prepaid rent, prepaid phone card, whatever the case might be. We paid the expense up front. Net Solutions had an unadjusted balance of $2,400 in their prepaid insurance account. 1 month has passed on the 1-year policy. So now instead of having 12 months of insurance, we have 11. We have to record an entry to reflect the fact that we've used up 1 month or $200 worth of that insurance policy. Again, in accrual accounting, we record expenses in the period they happen in. There's my $2,400 in prepaid insurance, and we're going to adjust $200 of it and pull $200 out of that prepaid asset to reflect the fact that we've used it up. Here's our entry. We're going to debit insurance expense, $200, and we're going to credit prepaid insurance, $200. The $200 debit adds to our insurance expense and recognizes it in the period that it happened. The $200 credit to prepaid insurance takes away from our asset of prepaid insurance and reduces our balance down to $2,200. We only have 11 months of insurance at the end of December because we've used up 1. There is our month we've used up, and there's our new balance in prepaid insurance. So we've come to that point in the video where it's time for you to give it a try. I've done the accounting on my side, and now you get to practice. I'm going to give you a couple scenarios of adjusting entries where we have a deferred revenue and a deferred expense, and see if you can knock them out of the park here. So here we go. On December 31, Wilmington Consulting Company had an unadjusted credit balance, $44,900 in the unearned fees account. Unearned revenue, unearned fees. Again, that is a liability. It's unearned. We've taken $44,900 from customers, but we haven't done anything for them yet. We've got to do the work. We've got to deliver the product before we can recognize the revenue and make an entry for the revenue. At the end of the year, only $15,600 in unearned fees remain. So $44,900 is where we began, and now we only owe $15,600 in services or product. Record the appropriate adjusting entry to take that unearned fees account from here to there at the end of December. Pause your video, take a moment, see if you can make that entry, and then I'll come back and show you what you should have. All right, hopefully you got a chance to make that entry. Here's what we're looking at. Unearned fees should be debited to reduce our liability. we're going to debit it $29,300. Fees earned, where we count the revenue, we're adding in the revenue here, is going to be our credit. And so here's our little T account. If you want to kind of see it from a T account standpoint, we began with $44,900. We had to get down to $15,600 because that is what we had yet to earn. How do I do that? Well, I subtract $44,900 minus $15,600 gives me $29,300. That is how I came up with my entry. I subtract one from the other and get the number to plug in there. It works out perfectly. All right, moving right along. Example number 2, we have a deferred expense, a prepaid expense going on here. We bought supplies up front, paid for them, and now we're using them as we go along. We can see we had a $2,700 balance at the beginning in supplies. We counted, we had $1,100 remaining on hand at the end of December. Make the entry to take our supplies from $2,700 down to $1,100 and recognize the expense involved. Pause the video, make your entry, and we'll come back and check it. All right, hopefully you've had an opportunity to make that entry. Hopefully, moreover, it looks like what you see right here. We have a debit to supplies expense, $1,600, and a credit to the asset account, $1,600. And again, breaking it down from a T account standpoint, we began with a $2,700 balance. We need to get it down to $1,100. We subtract the two. We got $1,600 to plug in there on our entry. One more. Prepaid insurance. You can see the details there. We began with $12,000. During December, we used up $10,000 of it. Record the appropriate adjusting entry. Here we go. Insurance expense debit, $10,000. Prepaid insurance, $10,000. Again, that credit to prepaid insurance takes our balance in the asset account down to where it needs to be. We had $12,000. We used up $10,000. We have $2,000 left. So that is our video. We've done accruals. We've done deferrals. We have one more topic to cover in adjusting entries. We're going to talk about depreciating assets and what kind of entry we need to make for that. So one more video as we plow along on our topic of adjusting entries. Hope to see you back here for that. As always, if you have any questions, feel free to reach out. I'd be happy to help. Until next time, take care, everybody.